A family can purchase a home, a place of shelter, a source of wealth, yet find themselves poorer each month as they service the loan that made it possible. A growing city can borrow funds to construct magnificent bridges, efficient public transit, connecting its citizens and boosting its economy, only to discover the annual cost of its obligations grows faster than its newfound prosperity. A powerful nation can issue bonds to global investors, funding national defense and scientific research. Yet the very act of borrowing can slowly constrain its freedom to act tomorrow. This is the central contradiction of long-term debt. It can build stability and introduce profound fragility. First, we examine the visible machinery, then the hidden mechanisms, and finally, the system effects almost nobody sees coming. Debt pulls future resources into the present, and the trade looks simple until time, uncertainty, and compounding begin to work. At its core, long-term debt is money borrowed to be repaid over years, often decades. Unlike short-term debt, it is designed to persist, not a revolving card balance or a payday loan, but a mortgage repaid over 15, 20, even 30 years. That extended timeline creates a durable borrower-lender relationship governed by contract, a contract that persists through changing economic seasons. Businesses use long-term loans and bonds to build plants, buy machines, and fund R&D. Investors lend in exchange for interest over many years and eventual principal repayment. Governments issue long maturity bonds to finance roads, schools, hospitals, social programs, and national defense. The perceived safety rests on taxing capacity and broad economic activity. Capital today builds the platforms that support tomorrow's economy. On the surface, it seems a clean trade. Benefits now, payments later. Add the principal and a predictable interest line, and you have the cost. But this view is dangerously incomplete. Long-term debt is a process unfolding through time, subject to shocks. To see why it works, until it doesn't, we need the whole system map. We'll move from the visible machinery to hidden mechanisms, and then to system-wide effects. Mortgages, student loans, corporate and government bonds shape daily life. But their risks are embedded in time, incentives, and feedback loops, and the rules reveal themselves only under stress. The simple story of borrowing and repaying breaks down with time and interest. A 1-point rise on a 30-year mortgage can add tens of thousands over the life of the loan. Early payments are mostly interest. Principal barely moves. 5 or 10 years in, equity can still be thin. A 30-year loan is a long bet on stable income. A 20-year bond is a bet on industry resilience and survival through recessions. A 30-year sovereign bond is a bet on political and economic stability. Over decades, shocks are probable. Job losses, technological disruptions, economic downturns, and shifts in demand. Crossing thresholds, like debt exceeding a safe share of income, changes behavior fast. Missed payments trigger penalties, raising balances, making repayment harder. Stability flips to crisis quickly. If this clear, mechanism-first approach helps you see the system, consider liking, commenting, and subscribing to System Atlas. Fixed payments create an illusion of predictability, while amortization hides risk over time. Nonlinear interest effects and long-horizon shocks produce sharp tipping points, explaining why systems that look fine can fail suddenly. Debt systems are driven by incentives, not just math. Lenders aim to be repaid with interest. They screen by credit score, job stability, and down payment. Perceived risk raises rates, protecting capital. Borrowers focus on monthly affordability. Longer terms lower payments but increase total interest dramatically. Firms are rewarded for growth, sometimes overlooking long-term risk. In booms, standards loosen and borrowers take on more. Easy credit raises demand and prices, which validates more credit. Pay structures can reward volume, not performance. When decision-makers don't bear long-term outcomes, systemic risk rises. The result? Fragile portfolios that crack under stress. Debt can create virtuous cycles when funding productive assets. A city borrows to build transit, improving access to jobs, attracting businesses and residents, lifting property values. raising revenues and easing repayment. But shocks can invert the loop. Job loss leads to missed payments and forced sales. Listings surge, prices fall, equity erodes for everyone. Spending drops, businesses cut, more layoffs follow. Debt burdens rise as incomes stall. At national scale, investors demand higher yields on rising debt. Higher rates raise servicing costs, forcing cuts or higher taxes that slow growth and shrink revenues. Benefits arrive slowly. Problems can be masked for years. New borrowing can hide weakness until the threshold is crossed. It feels stable, right up to the break. This negative loop pushes towards sovereign crisis. Feedback, thresholds, and delays, not headlines, govern outcomes. A young family takes a 30-year fixed mortgage. Early years go to plan. A recession halves income, pushing debt past a critical threshold. Forced sale in a weak market destroys equity and credit. A retailer borrows big to open 100 stores. Revenues rise, at first. Then demand shifts online. Foot traffic collapses. Interest outpaces revenues. Closures and layoffs erode sales further. A nation issues long bonds at low rates to fund programs and cuts. As debt climbs, sentiment flips, yields jump. Interest crowds out services or forces taxes, risking instability. If you value careful system maps over hot takes, like this video, add your comment, and subscribe for the next analysis. Across household, firm, and nation, the pattern is the same. Time, thresholds, and feedback make or break debt. The failure isn't the loan itself, but the structure around it. Long-term debt isn't a transaction. It's a system of cash flows, incentives, and embedded expectations. Outcomes emerge from the interplay of rates, time, behavior, delays, and thresholds. Stability depends on connections, not any one part. Align lender and borrower incentives. Promote transparency. Match loan term to asset life. Add buffers and stress tests so predictable shocks don't cascade. We can't remove risk, but we can make the system less brittle. The visible story of debt is never the whole story. Hidden loops and thresholds govern the endgame. The unresolved question, how much debt is too much? For you, for firms, for nations, under changing conditions. Learn how systems are built via central bank and research resources. Map your own debt with a nonprofit counselor. You've been watching System Atlas, exploring how the world's systems really work. Share your comments below. See you in our next episode.